Something massive is happening beneath the global financial system, and most people still can't see it. While governments continue printing debt, while central banks quietly prepare for another liquidity cycle, and while institutions scramble to preserve purchasing power in an unstable world, Michael Saylor believes Bitcoin may have already solved one of humanity's oldest financial problems. Not because Bitcoin is crypto, not because it moves fast, but because for the first time in history, ordinary people can own portable digital property that can move across borders, across political systems, and potentially across generations. And right now, in a world of rising debt, geopolitical fragmentation, currency instability, and growing distrust in institutions, that idea is becoming incredibly dangerous to ignore. Because according to Saylor, Bitcoin isn't just another investment anymore. It may be evolving into digital capital itself. For decades, investors believed wealth preservation meant buying real estate, stocks, bonds, gold, or national currencies. But the problem emerging now is that almost every traditional asset sits inside a political system. And political systems change. Governments change. Tax structures change. Regulations change. Empires collapse. This is where Saylor's argument becomes much deeper than a normal Bitcoin pitch. He's not simply arguing that Bitcoin will go up in price. He's arguing that throughout history, humanity has constantly searched for a better way to preserve economic energy through time. First it was land, then gold, then art, then financial securities. Now, Bitcoin enters the conversation as programmable digital property. And that matters because the modern world is becoming increasingly unstable financially. Global sovereign debt continues exploding. The purchasing power of fiat currencies continues eroding slowly over time. And institutional investors are beginning to realize they may need a neutral digital reserve asset that exists outside traditional monetary systems. That's the real macro shift happening underneath Bitcoin.
I think Bitcoin perfected it as a digital asset, which meant that it was now possible for 1 billion people to engage in this trade at the scale of $20, right? Like you can't borrow 100 million pounds to buy a building in London if you're an individual or a taxi cab driver, but you can actually buy $87 worth of Bitcoin off of an iPhone. And so Bitcoin changed the scale of this. It's like you have a building. The property rights of the owner of the building are much higher than the property rights of the person that owns the REIT. And so when you buy the entire building, you have a lot more power than when you buy a share of the building. With Bitcoin, you're able to buy the actual property in quantities $22 at a time or $87. And you are the original property owner. So you have property rights pari passu to the person that owns outright other forms of property.
This may be one of the most misunderstood aspects of Bitcoin. Saylor compares Bitcoin ownership to owning the actual Monet painting, instead of owning shares in a company that owns the painting. That distinction matters enormously. Because in traditional finance, most people rarely own the base asset directly. They own exposure, they own derivatives, they own paper claims. But Bitcoin allows direct ownership of scarce digital property without a middleman. And in today's macro environment, that idea is becoming increasingly attractive, especially after the rise of banking instability, capital controls, frozen accounts, sanctions, and growing concerns over financial surveillance globally. Saylor's core argument is simple. The harder an asset is to seize, dilute, censor, or debase, the more valuable it becomes over time. And Bitcoin's portability changes the equation entirely. You cannot move Manhattan real estate overnight. You cannot transport gold easily across borders. You cannot instantly relocate a bank vault. But Bitcoin? It moves globally in minutes. That portability may become one of the defining financial advantages of the digital age.
Oh, you have this much Bitcoin, you want to trade it for that truck, you want to do it on a Saturday afternoon in Africa, and maybe a politician in Egypt said it's illegal to buy trucks on a Saturday afternoon, right? You can still buy the truck. There's no one in the middle. When you rely upon a currency, you have to get the approval of anywhere from 1 to 6 banks before you can transfer the currency. So, if you're working with a banking network, and that's a challenge. And when you own other forms of securities, there are always securities laws. It's illegal to trade them on Saturday. Why? Just because. It's illegal to trade them at 6 p.m. Why? Because the bankers wanted to go home at 6 p.m. Huh? With Bitcoin, you can do what you want with your property, and you can do it where you want.
Now, to be balanced, Bitcoin is not without serious risks. Volatility remains enormous. Regulatory pressure can absolutely affect adoption. Governments can restrict exchanges, taxation structures, and banking access. And Bitcoin's price still depends heavily on global liquidity conditions. When interest rates rise aggressively and liquidity tightens, risk assets usually suffer, including Bitcoin. Critics also argue Bitcoin produces no cash flow, no yield, and no industrial utility compared to productive assets. Those are legitimate critiques. But Saylor's response is interesting because he doesn't position Bitcoin as a productive company. He positions it as economic energy storage, a monetary network, a digital property protocol. In other words, Bitcoin may not compete directly with tech stocks. It may compete against monetary decay itself. And that distinction changes the framework completely.
There was a marina full of luxury yachts and the economy was booming and everybody's spending a lot of money. And then the day the law went into effect, the marina was empty and the yachts all pulled up anchor and left.
Yeah. Awesome.
Okay, so that's portable property.
Yeah.
Okay, you can't move a building. The real problem with buildings is they can't run, they can't hide. So when the socialists or the communists take over, the first thing they do is they take your building because they can. And in fact, even in a capitalist nation, let's take the United States. What's the worst possible tax treatment? It's a triple tax treatment on a piece of real estate. We tax you when you sell it. We tax you when you inherit it. And then we tax you just when you hold it. Even if you're just holding it for a year without doing anything, you get taxed on the coming, the going, and the in between. Right? There's nothing that's that bad. Right? I mean,
yeah. There's no jurisdictional arbitrage with the building.
And that's because you can't run.
Can't run.
Okay, so the thing about this is with Bitcoin is it's the hardest thing to tax. It's the hardest thing to steal. It's the hardest thing to impair.
Here's where the macro conversation becomes extremely important. The world is entering a new era of monetary competition. The United States continues expanding debt levels. Countries are increasingly discussing alternatives to dollar dependency. Central banks continue purchasing gold aggressively. Meanwhile, institutions like BlackRock have legitimized Bitcoin through ETF products, opening access to trillions in institutional capital. This changes perception dramatically, because Bitcoin is no longer just a retail rebellion. It's becoming integrated into the global financial architecture itself. And perhaps most importantly, younger generations already understand digital ownership intuitively. To them, digital property is normal. Digital identity is normal. Digital value transfer is normal. So Bitcoin increasingly aligns with the direction the internet economy is already moving toward. That doesn't guarantee success, but it explains why capital continues flowing toward the asset, despite volatility.
The whole genius of Bitcoin is, the idea is this. A bunch of people get together and they have a conference and they think, well, we just like to keep our money forever and we don't trust each other and we don't trust any bank and we don't trust any government. And I kind of trust you right now and you trust me right now, but I'm not going to trust your idiot grandson in 100 years. So let's construct a bank in cyberspace. We'll all put our money there. Who's going to run the network? Who's going to run the bank? Well, no one. We're all going to run the bank. Well, why? Because nobody trusts anybody ever. And where are we going to run the bank? Anywhere? Everywhere. But what if one nation goes bad? Well, then the network will migrate out of that nation. What if a company fails? The network will migrate away. Well, what if I start lying? What if my node broadcasts, improper or erroneous or fraudulent transactions? You get kicked off the network. So the whole idea of Bitcoin was, let's create a viral bank in cyberspace that feeds on chaos. And let's start with the assumption that we can't trust anyone or anything anywhere over a long enough timeline.
The timing matters because trust globally is deteriorating. Trust in governments, trust in banking systems, trust in monetary policy, trust in long-term purchasing power. And historically, when trust weakens, capital searches for harder assets. Gold benefited from this historically. Now Bitcoin is increasingly entering that conversation, especially because it combines scarcity with portability. That's the breakthrough. Saylor repeatedly emphasizes that Bitcoin behaves like economic energy moving through time and space. And while that sounds philosophical, it's actually deeply macroeconomic. Every investor is trying to solve one problem. How do I preserve purchasing power over decades? That's the real battle. Not price, not hype, purchasing power. And in an age where fiat supply can expand rapidly, Bitcoin's fixed supply becomes psychologically and financially compelling, especially to institutions managing long-duration capital.
In theory, anybody on Earth can be a custodian or a counterparty. So you've got 8 billion choices. In fact, you've got every computer on Earth. So you've got billions and billions of theoretical choices. Are they all safe? No. Are any of them safe? Yes. You know, can you conserve your economic energy in time and space? That's really the question. And if you're, people were using Renaissance Italian art as a source of capital preservation in 1600s. So people have used diamonds, they've used art, they've used gold. In the biblical times, they used ox, cows, right? Livestock. What are these things? They're just economic wealth that's portable. And I'm using the best technology. And for a while it was camels or cows. The Mongolians thought it was horses, right? And maybe it was gold, but now we've got Bitcoin. Bitcoin happens to be the best technology for moving economic energy through space or through time.
One of the most important parts of this interview actually has nothing to do with price. It has to do with simplicity. Saylor warns repeatedly against corrupting the Bitcoin protocol. And this mirrors how foundational systems evolve historically. The internet succeeded because TCP/IP became stable. Language scales because grammar remains stable. Mathematics works because the rules don't constantly change. Bitcoin's strength may ultimately come from predictability, not complexity. This is where Saylor separates Bitcoin from many speculative crypto narratives. He sees Bitcoin less as a fast-moving tech startup and more as digital monetary infrastructure. Slow, stable, secure, durable. That may not sound exciting in crypto culture, but for institutional capital, stability is everything.
Don't corrupt the protocol, right? The protocol works, it works fine. Don't corrupt it. At this point, Bitcoin has won the battle to emerge as global digital capital. Just like Arabic math is won, just like the English language is won. There are certain protocols that have emerged, and we base Western civilization on those protocols. And Bitcoin is one of those protocols. The biggest risk to Bitcoin is bad ideas driving iatrogenic protocol proposals. It's like somebody wants, it needs to go faster. We don't have enough bandwidth, right? Remember the block size wars. Have you gone to Clark Moody's dashboard in the past week? If you go to Clark Moody's dashboard, the average Bitcoin transaction costs 32 cents, and the cost, was 1 sat per VByte for instantaneous transaction, 1 sat per VByte for hour transaction, 1 sat per VByte for a transaction this day, 1 sat. But literally the lowest measurable transaction fee on the network. And this is 10 years after the block size wars. And there was a war fought over that. People thought Bitcoin will fail unless we increase the bandwidth of Bitcoin because it needs more. And the answer is no, it didn't need more.
Whether you agree with Michael Saylor or not, the bigger question may no longer be whether Bitcoin survives. The bigger question may be whether the modern financial system is entering a phase where digital scarcity becomes more valuable than physical scarcity. Because in a world driven by AI, digital economies, remote capital flows, geopolitical uncertainty, and rising debt, portable digital property starts making more sense. And perhaps that's why institutions keep entering despite the volatility. Not because Bitcoin is perfect, but because the alternatives may be weakening. That's the deeper macro conversation now unfolding globally. Bitcoin may still crash violently. Regulation may still tighten. Markets may still overheat. But underneath the noise, a growing number of investors appear to be asking the same question. What if digital capital becomes the foundation of the next financial era? And if that shift is already beginning, then this entire decade may look very different from the last one.